SN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
And welcome. You're listening to the Financial Survival Network. It's Kerry, Lutz, and you've heard about Moneyball, and you've heard about Freakonomics, and heard about using analytics, using numbers to understand exactly what's going on in the world and how to profit from it. I mean, that's what the quants try to do. And interesting person here, Andrew Zatlin. He runs a big data firm called Moneyball Economics. And what they do is try to capture the data to help explain trends, explain what's going on around you and how you profit from it. I'm going to share that with you now. Andrew, welcome to the show.
Kerry, thank you for having me.
Sure. So, Andrew, Moneyball Economics, obviously a little takeoff from Michael Lewis's book, Moneyball, which dealt with the Oakland A's, making a little bit of money for baseball players. Salaries go a long way in terms of performance. And I guess there's a similarity here. So being a resident of Silicon Valley area, you seem to be passionate about semiconductors, internet technology. Obviously, the passion ties in with your approach to economics, right?
Well, yeah, if I could take a step back, the similarity isn't to Michael Lewis's book, Moneyball, it's the fact that I resemble Brad Pitt. I just want to be very clear. Brad Pitt, the star of the movie, not Jonah Hill. Jonah Hill.
I saw a resemblance, and I didn't want to make any presumptions. But now that you mention it, maybe you missed your calling.
You're too kind. I think the approach that we take is the same as the Oakland A's. It was how to get information and convert that into business. How to make it actionable intelligence. And there's a lot of data out there. The key question, though, is what's the data that matters? And then how do we convert that into some kind of investment action? And you mentioned semiconductors, for example. Really, I think most investors, we can go across from a commonsensical standpoint. We look around us today and we can pretty much see when the economy is doing well or not. And everything we do, where we shop, if you go to Whole Foods, is it crowded? Well, that must be good business for Whole Foods and reflects on the consumer and so forth. The same thing's actually going on with semiconductors. That's just one example of where I look at just everyday life experience and use that information in a very quantified way. It's got to be data-driven. It's got to be analytical. It's got to be robust enough to stand the test of time, in other words. It can't just be, hey, my Uncle Charlie gave me a stock tip type of move. And one thing that Silicon Valley's known for, and I think it's kind of insular and isolated because we don't really share the secret, and I'm trying to share it, we're known for high tech, but we got our start with semiconductors. And I think what we understand here in Silicon Valley is that semiconductors in the 21st century economy is the same as oil and steel and cement were in the 20th century industrial economy. And if you want, I can walk through sort of the fundamental mechanics of why that is and why watching semiconductors is the best indicator out there.
Absolutely. Love to understand that analogy better.
Okay. My kid had a birthday and I went to get a balloon, for example. And if you tap the balloon, the thing could sing happy birthday. It was amazing. Well, that's a semiconductor. What's happening today is that semiconductors are either in the things we're buying or they're in the machines that made the things we're buying. There's more semiconductor penetration in the world than ever before. It's no longer just in a computer. We've got it in every consumer device, but we also have it in every industrial device. The cool thing about semiconductors is they have this really tight supply chain. The manufacturers are talking to their suppliers and they're talking to the end users. And pretty much you have this really tight chain of awareness. When Apple wants to do their iPhone, for example, when they released it in September, 6 months prior to that, they went to their suppliers and said, this is what we're going to need when we're going to need it. And then those semiconductor suppliers turned around to, they have some components like silicon wafers, and they turn around and say, well, we're going to need this. So you have this 9-month chain of events that has to happen in order to make something in this world, no matter what it is. For example, we look at Caterpillar as one of those bellwether stocks. Caterpillar, which makes machinery for agriculture, construction, manufacturing, wherever they are. Let's watch Caterpillar because that's a window into industrial production. Well, the truth is, you can go beyond Caterpillar and look at a company called Rockwell Automation. They make semiconductor chips that go into everything Caterpillar makes, as well as every piece of factory equipment out there. And that's the beauty of semiconductors. It's not just that you've got this tight chain. If month one, this behavior is going on, that's going to signal industrial production 9 months down the road. You get that early visibility. But you also get it focused. There are only a handful of companies that are, for example, supplying chips to automobile companies. If you want to play the auto sector, you just have to watch those chip companies and see what they're doing. Same thing with factories. If you want to know what's going on with production, just look at what's going on with Rockwell Automation. Are they selling more chips? Who's buying them? And that kind of a thing. Semiconductors are fantastic as that prism into either at a sector-specific level or even the macroeconomic level. They really tell you, because of the nature of, they don't have a shelf life. These aren't tires. You can't just overbuy and then stick them on the shelf and eventually, draw them down. Semiconductor chips obsolete within 3 months. So that's why that nature of that supply chain exists. A manufacturer really has to know what their end user is going to be buying, when they're going to be buying, and how much they're going to be buying, or they're going to be stuck with chips just sitting around that have to be thrown away.
Gotcha.
So, it is the oil of the 21st century. You want to know who's growing, what countries and what sectors? Watch semiconductors.
So you look at the semiconductors, and what have semiconductors been telling you about the economy, where it's been over the past 8 years since we've had the Great Recession, where it's going, or 7 years, I should say?
Yeah, it's hard to believe that it's been that long. One of the things that's interesting is back in the second half last year, semiconductor manufacturing orders for equipment slowed down, and they actually started to contract. Now, that's a really important red flag. Here, semiconductor companies, remember, they're building to order for the most part. They're in constant contact with their end users. All of a sudden, they started hitting the brakes in the second half on equipment that would allow them to expand production. So the message in the second half from the semiconductor guys, and they're early in the production cycle, they were basically signaling everything's fine, steady as you go, but we don't expect a lot of growth out there. We don't expect contraction, and we're talking about 2015, but we don't expect there to be a lot of growth. Now you fast forward about 6-7 months, and all of a sudden, the experts started popping their heads up and revising down all the CapEx, and there's all these other things finally hitting mainstream. So what you have is a signal from the semiconductor companies very clearly saying our end users, whether they're automobile companies, whether they're some kind of high-tech communication companies, wherever they're sitting, every single one of our end users is very sensitive to the macroeconomic environment. If you want to, we're talking billion-dollar plays. And their end users were telling them the macroeconomy is slowing down. The demand just isn't there. That was a clear signal a few months ago, and it's been consistent. And again, the message is steady as you go, no acceleration, no deceleration. Now, you take that piece of information, and all of a sudden we're seeing data come out. Today China announced that their industrial production slipped into contraction. We've got some spring rebound about to happen in the U.S., I believe. But once we get away from the trees and we get back to the forest, we can have a month-to-month contraction or expansion. It's the forest that we're more concerned with, because as investors, we're not trying to trade every single bit of information. We're trying to put our money where it's going to do us the best good over the long haul. And in the near term, you've got the forest, which is the semiconductor companies, setting that background of, look, things are good. There will be the typical zigzag, but let's not get too excited. There is no massive acceleration. To use a Moneyball baseball term, this is the ninth inning, and we have to get a little bit more defensive, I think, as we go forward. And looking at a global slowdown, looking at maybe a little bit more of a spring rebound for the U.S. like last year, only for it to peter out in the second half. I'm taking all this into account and wondering, how do you factor in a rate hike when everything is slowing down? So,
good question that I've been troubled by from the get-go, and all these prognosticators have have been saying it. The Federal Reserve's been saying it. And I've been skeptical, quite frankly.
It's, I understand why people would say there should be, if the Fed can't raise rates when you've got GDP almost hitting 5% last year, in the third quarter, when you've got unemployment below 6%, when can they raise rates, right? And the answer is because the data points I just mentioned, GDP being X percent or unemployment being 5 point whatever percent it is, those are no longer reflecting the real economy. I mean, the way they collect unemployment, for example, is hilarious. They pick up the phone and they call people who are at home. The Census Bureau was busted almost a year ago for faking the data. Basically, again, it's human nature. They were paying people to go out and ask the questions, do the surveys on a monthly basis. And unfortunately, they couldn't get it completed, so they just started filling in the data themselves. They were busted for this. But in any case, just the concept that you're going to pick up the phone and call someone and get their opinion on whether or not they have a job or they're looking for a job, that's 20th century. Who has a landline anymore that they're going to be sitting around being called? So what you have is you have these data points that are no longer, they're obsolete. They're no longer reliable. And that's partly why the Fed has been so hesitant. And they threw out the unemployment rate as a gauge of what they're going to do. When Janet Yellen took over last year, she effectively said the unemployment rate is just no longer reliable. We can't look at it. We have to look at other more real metrics like labor participation. And what you have is really kind of what I'm working on. What's the right data? What's relevant today? And looking at the economy, I mean, we've got, for example, the semiconductors, we've got payroll data. All the data that I look at is pretty consistent that we're on the downslope. Things are still growing, but that rate of growth, that momentum is slowing down. The U.S. right now is in a better place than the rest of the world, but eventually it catches up with us.
Of course.
In the meantime, you got the Fed talking about a rate hike, but they pretty much got exactly what they would want from a rate hike if they were looking for a strong dollar, which typically happens after you raise your rates. I mean, we got a strong dollar just by jawboning simply because other countries are in a race to devalue their currencies because, again, they know that the economy is slowing down. So I don't, Fisher just came out and said, we'll do a rate hike, but it'll be towards the end of the year. Nudge, nudge, wink, wink. Come on. In my book.
Who's kidding whom?
Yeah, there's no rate hike. And if they do a rate hike, it'll be one of these nominal rate hikes, and then they'll probably end up backing off of it. They'll reverse course. I mean, one of my preferred data points that comes out that everyone gets to see is the jobless claims number. And what's interesting is that's actually the one figure that nobody pays attention to, and yet to me is the only reliable data figure that's produced by the government for conventional economics. And I say that because it's not modeled, it's not sampled. They don't go back in time 20 years after the fact and try to revise numbers. Someone stepped up and put a piece of paper down and said, I don't have a job. It's comprehensive. It comes out weekly. And it has a batting average of 1,000% of predicting inflection points in the economy. It just does. And we can go into the mechanics of why, but fundamentally, you've got a set of data that comes out that covers the entire country. That's the raw, real data. It has that 1,000% batting average is its ability to anticipate 9 to 12 months in advance a recession. And it does it in a very simple way. If the economy's growing, then it's creating more jobs. And the reverse of that means it's creating fewer jobless claims. So you get to a point in the economy where you want to look at this year versus last year, the year-over-year comparison, and it should always be below 100%, meaning this year's jobless claims are fewer than last year's jobless claims. And what you find is, historically speaking, recessions start 12 months after that figure hits 95%. Playing with numbers here. Fundamentally, the concept's the same. Once the economy stops throwing out jobs, it's plateaued. The next step for the economy is the opposite. It's no longer creating jobs, it's now cutting jobs. So you get that plateau point, and historically speaking, it's when jobless claims this year versus last year are almost the same. I call it the 95% factor, just because the stuff I've done shows 95% is when, let's face it, you're only talking about 10,000 claims. The difference between this year and last year, 10,000 claims. It's noise. When we're talking about a working population of 125 million, a few thousand claims is noise. And what happens is once you get to 100%, meaning this year we've got the same number of jobless claims as last year, you're heading towards a recession. Now, the market's not going to wait for that confirmation of a recession. The market already pretty much knows that things are slowing down. Focusing in on the jobless claims number gives you some advanced capability because you don't want to wait for 100%. You want to wait till it's approaching 100% because by that point, you're on the slippery slope. You've reached that tipping point. You might as well get defensive. Well, today, we're at 92%, so we're in a good place. But you got to be careful here because sometimes that figure kind of gets distorted by storms. And so as we come out of the recent storms, I'm going to be focused in the second quarter on what that jobless claims number is telling us. As it gets closer and closer to 95%, right now my money is in the market. But as it gets closer and closer to 95%, I'm going to get defensive.
So you're saying that because jobless claims haven't risen, they've been decreasing, that's that one number totally trustworthy and pretty much you can bet the farm on it?
Pretty much. Not pretty much. You can bet the farm on it. It's a very simple metric. And if someone has a dashboard, just a handful of things that they wanted to pay attention to, this should be their number one thing. It's the year-over-year jobless claims, not the, let me just be careful here, not the seasonally adjusted one, but the not seasonally adjusted one. So we want to take the raw data. Because
we don't believe in the seasonal adjustments because they're too susceptible to political manipulation.
Not so much political. It's taking something and kind of trying to smooth it out a little bit. And thank God they only do a little bit. When you talk about other metrics, they go crazy, and you go, wow, how did you do that? That's fascinating. If someone fat fingers that. But with jobless claims, for example, they telegraph a year in advance what the seasonal adjustment will be. So there's no hidden agenda. There's no surprises, which is nice. But again, I like to look at the raw data. Who walked in off the street? And I also take it to the next level. I like to look at the state level because you can have things like we're having when Hurricane Sandy hits or when you've got the back-end shields affecting oil. Those are regional problems that can distort the picture. Mm-hmm. What I do for my clients is try to clean things up, make sure it's apples to apples. So, for example, last year, California has a drought. Why do we care? Well, California drives almost 25% of our jobless claims. Well, here's what happens. Farm workers can file for jobless claims. Because of the drought, we had fewer farm workers. Well, then you fast forward to the end of the year, which is the fall. There are fewer workers, so that meant there were fewer workers to fire. And that's why jobless claims suddenly plummeted last year, starting in about October. It wasn't that there was an improvement in the core economy. It's just that there were fewer people to fire, and the seasonal adjustments didn't take that into account. This is the kind of nuance that we got to be careful of. But that's why I say don't pay attention to it every week. Pay attention to it on a monthly or quarterly basis. Watch, because these kind of distortions do start to go away. The reason I'm focused on it right now, and the reason I say we're in the ninth inning, claims today at 290, 300,000 is what the seasonal adjusted number is. Well, last year, August, barely 5-6 months away, they were at about 320. So about the same number, not that far away. And then they fell down to 300. In other words, we're approaching that point where this year's claims are the same as last year's claims. And every single time we've been here, every single time, the recession is within 12 months. Every single time. But the stock market falls a little bit before that. And so you can make money.
Yes, it's a leading indicator. In theory.
It is. Well, and you just touched on something I just was commenting on to my clients this week. Everyone says, labor is a lagging indicator. The traditional conventional economists sit there and say, it's a lagging indicator because the economy grows and then you see payrolls. Well, in fact, if you take that metric I just mentioned, year over year jobless claims, and you map it against the GDP, you'll find that, in fact, it's coincident. And it's coincident for a very specific reason. Jobless claims, me hiring or firing somebody, is based on my expectation of what's happening. Remember, jobless claims really move most people may not know this, but jobless claims are really fluctuating based on construction worker, retail, basically a lot of the bartenders, these temporary or part-time workers. In other words, the marginal workers are driving jobless claims. And marginal workers are the first to be hired and first to be fired as near-term economic conditions shift. These are people who don't get to sue because they were wrongfully terminated. There's no unions protecting them. There's such slackness in the labor market. Employers can hire and fire at will, and so they will. They will basically what you see in jobless claims. If things get, if the economy is accelerating or they expect it to, they'll move. So jobless claims coincide with the economy, But here's where it gets interesting. Jobless claims are in real time. I will find out on Thursday what happened last week. GDP gets released, and it's almost 4 months old. It gets released a month after the quarter's done, and it references data that's 4 months, 3-4 months old. And that's typical for most metrics. And so when I say it's a leading indicator, what I really mean is it's a coincident indicator for the economy, but the simple mechanics of how the data gets released gives me a couple months edge. So why find out? It's always famous when they say, okay, we're now officially in a recession. They say that 6 months after that technical timing happened. Yeah, but jobless claims told me 6, 9, 12 months in advance that we were going to be in a recession. I didn't need someone else to come out and officially say it well after the fact. And as investors, and what we're talking about, jobless claims, really, companies are driven by just two things, capital and labor. And so if we can get a good line of sight to what companies are doing with their labor, we can make adjustments. And the stock market, Wall Street knows this, but Wall Street is locked into a 90-day cycle of when quarterly earnings are released.
That's for sure.
So, we just went through one period of quarterly earnings, and a lot of the questions on those earnings calls were, right around, what's going on with CapEx and what's going on with your hiring. And you had companies, some of them willing to say that they had some visibility and some clarity. But when you don't have visibility and clarity, you're not going to be hiring a lot, and you're not going to be spending a lot on your CapEx. And that gets back to what we see with the semiconductor companies, which is there's a steady as you go, but there's no indication of acceleration or deceleration. Everyone's kind of in a holding pattern, a wait and see moment. Unfortunately, that wait and see can spill over into, well, we're not going to hire, and then into layoffs. As your top line starts to shrink, companies typically, they pull the trigger. They have to protect the bottom line. Right now, we're saved by a lot of commodity deflation. And so you don't have that margin tension and that need to fire. But again, that kind of fizzles out as we get into the second half. A lot of that gets played out and has rippled through the economy. First half is going to be great. You're going to hear nothing but positive macro going forward for the rest of this half. And the market's probably going to sit there and say, well, we're seeing all this great macro. This is exciting, except that just reinforces the idea that the Fed's going to raise rates. Problem is, second half isn't going to be so exciting. Second half is actually going to see more inflation, slower consumer spending, and then you're going to have talk of raising rates. So you're going to have this unfortunate friction that I think is going to send a chill through the stock market.
Interesting. And Moneyball Economics, fascinating. Tell us where we find out more, how we connect with you, Andrew.
It's free. I hope that's a good price for everyone.
Yeah, Moneyball Economics. It's definitely affordable.
And today, what's deflation? What's the inflation on free? But yeah, moneyballeconomics.com. Every week, I'm producing a report that will go out that brings home the reality of the economy, the data points we should be looking at, updating folks on different things. There's a free report we have right now, a special drill down where we're looking at, basically, I call it hookernomics. It's looking at vices, looking at prostitution, drugs, gambling, things like that, and showing how consumer spending on vices really is a leading indicator for all kinds of consumer spending and what's going on in the economy at large. Come on in, it's free. And hopefully there'll be some great information going forward that folks can leverage for their investing and be successful.
Yeah, that's really fascinating. As always, you'll find a link to the site on financialsurvivalnetwork.com in the show notes to this interview. Don't forget to sign up for our mailing list and get ready for our next webinar coming up the week after next. Andrew, it's really fascinating. I love different perspectives on what we think we know, because what we think we know is often not the case. In fact, I've made my living and staked my business career on basically assuring myself that what I think I know is almost always wrong. And hey, look forward to having you on here again from time to time to let us know what's taken place. So on that note, we will speak with you again. Good luck here, and keep us posted.
Thank you very much, Kerry. And bring me back in a few months. Hold my feet to the fire. I've said some things today, and let's see how they play out.
We absolutely will. Thanks so much.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.